Do you need gold in your investment portfolio? Short answer is yes. We're going to cover why you do and how much you need. And there's a lot to cover, so let's get into it. So one of the most commonly stated value propositions for gold is that it's a hedge against inflation. So that's probably the best place to start. Let's talk about inflation and what that means for your money. The normal expectation for inflation is 2%. And what that means is that every year the dollar loses 2% of its value. And that is in a healthy economy. So if you want a silver lining on that, you can look at it like any debt you have decreases 2% each year right along with it. So if you have a mortgage, for instance, inflation is chipping away at it as well. And I think we normally think about rising home values solely as appreciation, but there's more going on than that. 50 years ago, if you looked at the median home price in the United States, you'd see that it was $25,000. And today, it's at about $320,000. So houses are larger and nicer today, but not 13 times larger and nicer today. The reason is that the value of the dollar has simply decreased. So like I just mentioned, the value of the dollar typically decreases at about 2% each year as more money keeps coming into the system. But if the Fed prints money faster than the economy grows, then we'll see the rate of inflation increase even further. That seems pretty simple, but it's not. So we actually came into 2020 seeing deflation, and we saw that February through May, and that means the cost of goods has actually gone down. That's both a factor of supply and demand, but it would normally depress the price of gold, and that's not what we're seeing. What we're seeing instead is that there's a steady rise in gold price. It's not the current inflation. It's because even though the buying power of the dollar has been on the rise, gold price is adjusting to concerns of future inflation. And we all know that's coming. So if the Fed prints money faster than the economy grows and we see rising inflation, that spurs an increase in this stuff, in the price of gold. If you were to look back again at 2006 spot prices, you'd see gold was at about, I think it was at $600. And then 5 years later in 2011, it was above $1,800. We're seeing similar conditions today. And try to do this without cutting my fingers, I'm talking. The similar condition right now is QE infinity. So QE, of course, is quantitative easing, and QE to infinity basically means the Fed is willing to make any large-scale asset purchases it needs to make until the economy comes back, and they're willing to print as much money as it takes. So that's going to cause greater inflation down the road, and gold prices are paying attention to that. Another factor that affects inflation is buying power. I'll just show you this coin close up real quick. So greater buying power means higher inflation, and the Fed is able to affect that through interest rates. Raising interest rates is a way of reducing inflation, and lowering them is a way of spurring economic growth. So in addition to aggressively printing money, the Fed is also lowering interest rates. They're lowering them to record lows, and both are factors that result in rising inflation. So it's a big reason gold futures are up. They're trading up about 20%, and safe to say that investors want gold to offset those future losses on the dollar in dollar-backed investments. And honestly, that's only one of the reasons I buy gold. Put this away before I drop it and break something. So that's why you need gold. How much gold do I need in my portfolio? Charles Schwab just released results from a survey showing that people think they need about $1.9 million to retire. Now, I think that's probably low, but we'll just assume that ignores fixed or income earning assets like real estate or businesses, but we're going to edge it up just slightly to $2 million to make the math easy. So again, I'm no financial advisor, so I can't tell you how to position that $2 million across cash and investments, but I personally want about 10% of my own diversified away from US dollars, and half of that in physical gold. So without showing my work on that math, that would be about $100,000 or about 50 ounces of physical gold. Again, that's if I was retiring today and if I thought $2 million was the right amount. So why physical gold? Well, there are a few reasons. So first of all, and in general, I want my money to grow, and saving rates don't even stay above inflation. So I invest the bulk of my available income in the stock market, in my IRA, and in real estate. But if you look at all of those classes, stocks are risky, IRAs aren't accessible until I think right now it's 59 and a half, so almost 60, and real estate simply isn't liquid. So in order to make those investments, I need a hedge. I need a hedge for downturns or for immediate access to cash. And gold provides both of those. So if I need cash during a down economy, whether that's 10 years down the road, 15 years down the road, or 2 years down the road, I can sell some gold rather than being forced to get out of real estate or out of the market at a bad time and lose a bunch of wealth I built up. And that's pretty simple. The thing that I'm not especially concerned with is the collapse of the dollar. If you want to hear about that, the looming financial apocalypse, there are plenty of channels here on YouTube covering the scary angles. I'm a little more pragmatic than that. My reason for wanting physical gold is that it's both liquid and it's not correlated with the market or the current strength of the economy for that matter. And it also creates versatility with other investment classes because I have a fallback option if any of those other things go south. So in other words, I don't need it to shoot the moon since I'm not buying it for speculative growth. I don't buy it as an exclusive preservation of wealth. I buy it to balance the highs and lows of volatile markets. And I buy it to allow me time to get out of the other assets that aren't liquid. So to recap, it's kind of like a little omnibus. I don't know if I'm speaking too fast or too slow. It depends on who you ask. But to me, gold is more versatile than it seems. And it's even more versatile when it's paired with other assets. It doesn't have to be productive on its own. It doesn't have to pay dividends. It doesn't even have to grow in price aggressively to be valuable, at least not to me. It makes my entire investing strategy more stable and more productive. So you won't hear me pumping gold on rising prices. Next year at this time, they might even be going the other way. They might be going down, but I'll still be buying it for all the reasons I just ran through, and I'm sure others will be too. So that's how gold works for me, and that's why it's an important part of my portfolio. Just thought I'd cover some of those ideas quickly, cover why I think it's part of an investment portfolio, why I think it's an important part of a retirement portfolio, and just kind of cover the idea of how gold works. And if you found this video interesting, if you liked it, if I gave you something to think about, I would love it if you hit the like button and talk to me in the comments. And also, I've been showing some of this gold rather than showing a bunch of charts. I'll post a few links to videos that I've covered on popular ways to buy gold, some of the coins that I think are the best to buy. And I'll do that in the comments. I'll drop up a few boxes here and over here maybe. And you can get into it further if you'd like. And if you're interested, please subscribe. I always appreciate you watching. Would love to see more of that. Anyway, thank you for watching this one. I appreciate you coming out. Take care.